Welcome back to my channel. Today I'm going to review the Graph GRT token. For those who are unfamiliar with my channel, what I do is I research projects in the crypto space. I feed them into a model. The model has an output. I weigh that model's output to reality, and I reflect and modify the model to better correlate to higher ROI opportunities in the cryptocurrency space. This is the model. The project is the Graph. I'm going to dive right into it. So what problem, market, thing does this project currently solve or serve? The protocol is in indexing and querying data for blockchains, basically organizing the data in blockchains so that it can be accessible to decentralized applications. This is a decentralized solution for that querying of data. So basically it organizes data into an understandable pattern so that applications can access it from blockchains. It decentralizes the query API layer of web3. It allows for permanent applications without giving up decentralization or performance. So like it has native performance speeds just like the native internet. This is a rough drawing of what it would look like. I didn't want to dive too much into the technicalities of this, but basically you have applications on top of the subgraphs, which is the open APIs. That's basically the interactions of this protocol to applications to the blockchain. So you have on-chains connected through the graph to the applications. There's three different players involved here. This GoodNotes 5 automatically turns on the eraser. It's kind of annoying. All right, the indexers, the curators, and the delegators are the players involved, as well as the consumers. The consumers obviously pay for the services provided. They pay in GRT. They don't have to pay directly. The applications could take care of that in the back end so that the consumers don't have to interact or use the GRT token to do that. So when they do the request, it might be bundled in some other payment method, but ultimately these are going to be the payments, or the applications are going to be the payments for the services provided. The indexers get paid inflation as well as from the consumers. And they organize the data and basically coordinate the data to the APIs, to the subgraphs, etc. that are connections between the blockchains and the applications. Delegators also pick which indexers they want to add GRT stake to, basically saying these are the most productive ones. They can pick the most productive ones, and in exchange for that, they get income. So they basically stake. This is a proof of stake network. The delegators put their stake towards the indexers that are most productive because they want that payout. And curators, I think what their role was, they also help organize the data. All of these components lock up GRT for contribution to be collateral in the network. So the collateral could get slashed if you misbehave, etc. It's the part of the incentive structure of proof of stake. All right, I'm going to dive right into the model now, and whether the model predicts cash opportunity for the token. All right, so future increase in demand for the token. The model predicts a neutral statement for that. I'll just do this in purple because some people want to read it still. So I'll put what I do in purple. Price FOMO, neutral statement for that. Weak hands, neutral, because what we have is a lot. This is a good thing. A lot of people are out of the money, which means they're negative right now. That's a good thing. A good time to enter a token is when a lot of people are in the red, because you don't have to worry about so many people sitting on heavy profits. So a lot of people are out of the money. There's only 10% that are profitable right now. Hype risk, there's 50% of holders are greater than a year, 33% are at the year mark, within a year mark, and 10% are less than a month. That's still pretty high. I don't like to see that. That's why I put neutral. You want that to be as low as possible. Those people who recently bought within or traded within the last month, you want these numbers to be towards obviously the long-term holders. Composition by time held. Once again, you could see that it's neutral. Social metrics are also neutral. So weak hands rating for the model is neutral. Upcoming events. Now the roadmap looks decent. Basically, these were the things that they promised in March, but I couldn't find any of their blogs talking about the things that they delivered for those. But what they did deliver over the last year that I saw that was important was Substreams, Cosmos Hub, and Solana support. So they basically just added new networks to their interface. So that's good because that shows that what we can expect for the future roadmap is probably more integrations to other projects. They probably will go and try to integrate into projects that look like they have activity. And that's what you'd want to see because you want them to get customers. So that's why I said the roadmap is decent. Low inflation. So, the inflation is controlled by the token holders. So there's that element. Okay, so now into the basics. The token is staked for collateral to provide services to network. So basically it is a proof of stake network. That is like it will have a PDE, etc. Slash payment. It's collateral for service, for putting up the services to network, and that's just the simple basics of proof of stake. And the value of the target market for this. Difficult to really assess. Basically, what we're talking about here is data for blockchain activity, blockchain environments. We know that blockchain environments are contextual, protected environments that help hacker-proof value data. Anyways, it's difficult to assess. And I put, the general total data storage market is about 280 billion. So all of the world's data is going to move into the blockchain space. And so I said anything of value history, right? That's basically what we're looking at in the long run, maybe in the next 10 to 20 years, is the anything of value history, because all the world's value is going to move on the blockchain. That's something that I think is going to happen because this technology is too valuable. Like it's what it's designed to do. And this is the way to do it. So I would say it's probably anywhere from 20 to 200 billion is my guess. So that's the size of the market that we're talking about, a 20 to 200 billion market opportunity. And this project's market cap right now is about 500 million. So it's half of a billion. So that means if it was to be the dominant 80%er, and if on the low end, the 20 billion market, right? And this thing's at 500 million. That means it could potentially see, if it captured 80% of that, that would be what? 16, right? 16 billion. So that would be a 32 if it became, that would be a 32x. Oh, whoops. Let me erase all this. That would be a 32x if it was the 80%er of that lower market opportunity, if that was to happen. So that can give you an idea of where it could go from here. Okay, so now regarding the tokens, so fees that burn the tokens, there is an element of that is in there, and this is the usage right now, PDE burn. So I did some calculations, and right now its PDE is 40, just from the burn mechanism, no other things stated. So it's really burning between 800 and 400,000 a year, which is for something with a 500 billion market cap. We want to see those burn rates go up. It's PDE. From this burn, this is just the burn component, is 16 to 8 billion, somewhere in between there, justified market cap. And we're talking about 500 million. So this shows that it's a little overpriced from a PDE standpoint. And that's why these things are neutral. Now that could pick up if they get more traffic, if they get more fees to burn. So that's why we get a lot of neutral activity expected from token price performance from the model. Expected exponential growth. So let's take a look at that. It does have exponential growth, but we're talking about the fees for paying the network, and we're seeing it's only making really about 52,000 a year. That's it's basically irrelevant, right? So I was going to do two different points. I was going to show the total point and this point when it really started looking like it's taking off traffic, but I said irrelevant because we can see that at 57K a year, it needs to pick up a lot more than this in order to be justified at current prices for its the fees that are being raised on the network. But the good news is that it's picking up. So hopefully it can get quite some more usage. And hey, this is the very beginning of blockchain, so it's very likely that will be the case, and it's something to keep an eye on. But once again, it has a justified PDE of 1 million with these rates. So, it's justified at 1 million. It's 500 times bigger. So that's what the kind of growth we want to see. Whatever they're doing right now, they need to do it by or here it is right here, 600. We need to see a 600-fold increase to justify its current price. So that's why that puts that as a negative thing for the potential price performance. All right, now let's get into some good things. The governance model, it has it as medium, decentralized. The token is involved because it's proof of stake, and the indexers have the biggest vote from what I can see. Indexers have the biggest influence, it appears, and obviously those are the node operators, et cetera, et cetera. And so all the technical features, all the developer services, the APIs, the toolkits, the software development kits, all that stuff will probably get built out because the token holders and the technical people holding this token are involved in the governance, and so I expect all these governance, all these developer metrics and governance metrics to be pretty well covered from the model standpoint. All right, the team experience, they've seen this thing go to 6 billion during the market crypto hype stage, and so, they have experience seeing something go from 0 to a billion. If they stick with it, then we can expect this thing to do well, because now they got the experience seeing what it is to go from nothing to something. And even though we're back to the 500s, and maybe if it goes lower, they still could know how to, they still have those connections, they still have a reputation, and as long as they keep working, I think they can get it somewhere. Vitalik Buterin mentioned this. He said dApps were getting old data through the graph because Web3 API is slow. So this was showing that it was showing its usefulness for grabbing older data on blockchains. That's all I really care to mention there. But yeah, the team's got experience, etc. All right, so that's a quick run through of the models. Look at the graph. Basic summary. The cap is large for the PDEs or the usage rates. That's the cons. These are the cons right here. So the cap is kind of large for its current use cases. So it'd have to grow like 600-fold. And for the current burn rates, it only really has to grow actually 40, or let's say 60, or between these two numbers, about 60x in the burn rate. So if we see a 60 increase fold in and I can see that happening, right? Because we're at the very beginning of all this technology. So 60 fold to justify its current price. And then obviously that, if it was to do that 60 fold, it would be at par with value. And obviously there would probably be a lot more growth in its future from there. So you could see why these prices are where they are. But yeah, that's kind of the con, is that it is a little high for its PDEs. Large target market in the crypto industry. So... So another thing that's a potential con is, data, the data markets, index fee market. How big is that market opportunity? There might be bigger opportunities. Crypto could address different things and have higher ROI opportunities. There's larger, for instance, there's going to be 400 trillion in assets that comes in the crypto space. And I think that the target market for just pooling information, we are entering the information age. Data is new oil, as you've heard, but this isn't all data. This is just data related to context of blockchain space. So that's what we're seeing here in the size of that market, the size of getting history from blockchains. And that's definitely going to grow, obviously, as that world's assets come into the space. But how much will that fee be? How much will that cost be? The target size of that market, basically just indexing and data service for that. Like I said, I think it's my guess, this is just a guess, is 20 to 200 billion. And I think that there's a lot of other opportunities that may be bigger. Pros, they are the leader in the index space for Web3, and they will likely stay that way. But keep in mind, these are early days, and we could see the space is going to be rapidly developing, rapidly changing. Likely ICO damage is over. Like, those days are over. There is some tokens being released, but for the most part, you don't have a bunch of ICOs that are dumping on you. And then finally, usage is picking up. That's another pro. It is picking up. So hopefully it could pick up that 60x, in activity, and, blockchain is going to grow a lot. So, we're at the super beginning stages. We are in the, super beginning. So anything's possible there. All right, so that is that. All right, so that's the summary. I'm going to do my Patreon exclusive content next. If you like this kind of content, please like and subscribe. I aim to be to get this model correlated to the best ROI opportunities and the most accurate outputs possible. And I'll see you guys later.